Hello, good morning, all. It's 10 a.m. It's sharp, so probably we will leave 1 or 2 minutes more so we can have all persons together. Sorry for all who are here on time, but please let us ask this for 1 or 2 minutes more. Many thanks. Okay, so 2 minutes gone. I believe we can give it a start now. Many thanks for all of you joining us for this transfer pricing and more in particular the intergroup charges and the services. My name is João, along with Maria that will present herself. We are the partners in charge for the transfer pricing area for Baker Tilly Iberia. Uh, Spain and Portugal together. It was a decision to take this service line as a whole because many companies which are in both countries have the same tax manager, CFO, and so on. So we have one only team with persons in Lisbon, Porto, Madrid, Barcelona. On this presentation, I will be taking the first part of it. I will be more focusing on the transfer pricing economic part of it, always looking for what is intragroup services and recharges. And then Maria, if you want to introduce yourself and give a little brief presentation of what you are going to talk to.
Sure. Good morning, everybody. So this is Maria Mariñas, International Tax Partner for Baker Tilly, Spain, and I'm based in our Madrid offices. Thank you for joining us today. Yes, talking about intragroup services, not only TP rules and TP valuation is important, we also need to consider all the tax implications. So after Joao, I will try to give you a brief explanation about the key points on taxation.
Thank you, Maria. We have a area here on our Teams screen, the questions and answers Q&A. Please feel free to put any questions there. We will present, then we will have a part in the end to answer all your comments, questions. If it is very particular, our contacts will be in the end if you want to email us. The slides will be provided to you as well as a video recording of this webinar. We will try to be brief, probably 20 minutes each, and then leave the rest to you. The slides we have prepared here, they have or they have some questions, some examples. I will try to go on them on a high level perspective, so then you can have the slides. And if you have any questions, please feel free to put them on. Well, why have we thought that this was an important issue for a webinar? from the beginning, transfer pricing, or what does transfer pricing aims for? It tries or to capture if a multinational group is shifting profits or costs from one entity to another. That's the final goal of transfer pricing. And if I sell a pen from one entity to another, it's physical. The pen is here. Then we have services. A service is not tangible. So there are more focus of the tax authorities on intragroup services, as well as it could be more easy to transfer money from one entity to another, saying that we have rendered a service. So due to this intangible aspect of a service, and given the principal focus, objective, goal of transfer pricing rules, normally services are on the spotlight of tax authorities. So going now for and trying to distinguish between an intragroup service and employees recharges, okay, and then cost allocation or cost recharges. And the next slides will have more examples on this, but I will probably focus on this table here. Intragroup service is when one entity has like a central function of rendering a service to the whole group. IT services, financial, human resources, and you have to have in mind that if that is a real service or not. What do we mean with what is a real service? Then if you can prove that there are economic benefits, if you have evidence of the service was effectively rendered. Employee recharges is normally what in a multinational or when you call it a secondment. Okay, when your employee that we have here an employee in Baker Tilly, Portugal, that will move to Baker Tilly, Spain, Baker Tilly, France. There you only have to charge the cost of the employee. While in a service you put the cost and the markup, we will check how we do that. In an employee recharge, you only go for the cost of the employee. And then you have the cost allocation or cost recharge. Is when one entity buys a service for all the group and it doesn't add any value. If I hire an insurance for Portugal and Spain, I don't add any value. I will just recharge the cost of this insurance. Okay. Here, what can be tricky is if I'm working as a purchasing central. Okay. If I do those kinds of functions, there I could have some markup. But let's go here to try to focus on some more examples. The intragroup service is what I was saying here. It's normally what you see in intragroup services, and the key transfer pricing here, the key transfer pricing questions here is effectively if it was not a group company, would you go to the market and look for this service? Yes or not? And look, unfortunately or not, sometimes we know that the answer to this question sometimes is no. Okay, we should never write that on a transfer pricing report, but sometimes you know that you receive invoices from the group or not with services that you cannot measure them, and that takes us to the second question. Are you able to measure the benefit you take from that service? Yes or not? So this is for you to think. You can put us questions there. If I receive this invoice from the group, it doesn't, I'm not able to answer yes to any of these questions. What shall I do? What are the risks I'm taking here? The employee recharge, I believe we don't have many, nor there are any relevant questions here. It's obviously if someone, an employee from Portugal goes to Spain, it will be Maria there taking care of that person, will be paying his salary, controls, or as the person directing that employee. It's straightforward. The cost recharges, and here I moments ago I said the example of me getting an insurance for all the group. Here you have the headquarters rent. Yes, it's the same. If we are in the same building, two companies, one pays the rent to the landlord, and then you split it, taking in considerations the number of persons, the square feet whatsoever. But that's a direct cost that must be allocated according to some allocation key, but you shall not put any markup on that. So, and here we'll leaving this. It's very practical in the useful decision tree when you are with some services and you note that it shall be a recharge, it shall be a service, it is an employee rechargement or not. These questions here may answer that. Obviously, that sometimes, and you are in the same country, you think you put another tax topics here is that services may have or should have, it depends on the geographies, VAT, and the employees secondment doesn't. But that's another point. That's VAT questions. What we have here, this practical decision tree, is when you want to think if this is a service, an employee secondment, or a cost recharge. So this point here was to clear out what are this, or how can we put these three categories independently. Then this is a tricky part here, but tricky in the sense that if we go for the top of it, and sometimes there are management services, which then gets to the management fee. Okay, how can we measure the benefit of a management fee or of a management service or any other intragroup services? How does that service impact or my internal operational activity or my sales? Or is what I said moments ago, if I don't have that service from the group company, will I go to the market to look for a similar service? And that's the bottom line question. Then one important point is the duplication of services, and I've seen tax authorities going for this sometimes. Then you say, okay, the group renders to me financial support, financial services. Okay, but you have a financial director here, you have two persons on the accounting area, you have this. What does the group renders to you? So in here is a very important point. You shall have an agreement, a contract, and you must be aware in a transfer pricing report, there is a part where you describe the functions of your entity. You must be aware that what you describe in your functional analysis, it does not overlap what the contract, the agreement you have on your intragroup services. And tax authorities most or many times look for this for the cost duplication. And when you have central services being rendered by any entity in the group, sometimes if we don't look very close to the agreement and to the functional analysis we have written in the transfer pricing reports, we may have some problems here. Then, when tax authorities come there, you should have something to show to them. Okay, a management service. You have to have some reports, some slides, some Excel. You must have looking even here time tracking tickets of planes. Well, you should be able to demonstrate to tax authorities. Yes, the report is here. Check this email I have received. Just not getting the invoice saying management services. Okay, we need to have some support to that invoice. So, and in this, and look, if you have an inspection regarding 2023, it's very hard for you to have some evidence to produce some evidence back there. Okay, so in every year you should take a look at this and say, well, okay, I receive an invoice for management services, for human resources services. What is the evidence I had this service? It was rendered, and ask for. If you don't have any physical evidence, you should ask for the entity that is invoicing you, is rendering that service, to provide you with some evidence of that. Then, obviously, is the reality check. If we don't have this service, will my company carry on or not? Obviously, we can carry on with for a short period of time without some ancillary services, but in the midterm, in the long run, you must have all these services. So this is the acid test, the reality check test. If I don't have this service, will my company closes in the mid long run or not? So it is important and is ultimately what you have to think about. I have 3 minutes left, and I believe I can do it. So going now for some recharge of different costs and how to determine the arm's length. So basically, first of all, in this point here, if it is a routine support activity or high value service. What is this? Routine support is services that are typically the back office services, the human resources, the IT, the legal, in terms of routine. Okay, what is that typical work? It will be considered routine support. If add something more than this, routine is a high value service, and you will have to determine a specific markup. Then, what is the base cost? Because most of the times you think that, okay, I will need to check if my markup will be 8% or 10 or 12. But let's keep this in mind. The percentage you will apply will be applied to a cost base. And if the cost base is 10 or is 50, it is totally different, okay? And the impact may be huge. So when you are in this first stage considering what to charge to another entity, you will compute your direct and indirect costs, okay? Direct costs, if I'm rendering the service, is my hourly fee, okay? Indirect costs, obviously, you will put the cost of the computer, the rent, and whatsoever. This goes all to the cost base, okay? Then you have here exclude shareholder costs, okay? Shareholder costs are costs that a company, a parent company, cannot ever send to the subsidiaries. There are costs related with managing subsidiaries, and you cannot ever put that costs to the subsidiaries. So base cost, the direct costs and indirect costs, and then you will add it a markup, a margin. How do you define this margin? You have databases like Sabi. Sabi is database specifically for Portugal and Spain. You have Orbis that is for Europe. Then you have Bloomberg, more specific for some financial transactions. You go for these databases, and then you will have to filter, to sort with some criteria. And what is this? If you are looking for what margin shall I put on an IT service, you will look for IT companies that are independent. Why? So their margins are not influenced by their own transfer pricing policies. You will look for companies similar in terms of functions, risks, and assets. Okay, and then and in similar markets. That's why for Portuguese and Spanish companies, you shall use Orbis because or if you use Sabi. If you use Orbis, you must select the region, the geography for similar countries, for Portugal, Spain, and so on. Why? Because there are social economic factors that impact companies' margins. So this is another criteria you shall bear in mind when doing this benchmarking. Then you get to a set of comparable companies for transfer pricing purposes, and you compute a range of margins, markups, net operating profits, and this range will be the arm's length range. Is inside this range that you can apply a markup to put on those costs. Regarding the allocation keys, we were talking back there, and this can be applied for recharging costs or in services. How? Let's say a company that renders management services to other 3 group entities. And one way you can put it directly. I can say, me, João, I've been working 3 hours for company A, 4 hours for company B, and so on. Okay. Most of the times and in many situations, persons tend to forget or don't have this type of time sheets. So what we could do here is, look, I'm going to allocate my hours given in a consideration the dimension of each of these companies, or by sales or by some other point. If it is a human resources services, maybe I would allocate it by number of employees. IT is also obviously, and so on. So when you recharge a cost, or you are allocating cost with services that are rendered for more than one company, you also have to use an allocation key. Then common red flags obviously is connected with the slides we've seen moments ago, saying what is an evidence for tax authorities, and you should always be able to demonstrate that you received the service and that the cost base is well computed and that the markup is arm's length markup. You have to show the benchmarking you have done and the criteria you have implemented. This real world example is very simple, just the cost base, number of users, and then you got a markup of 6%. Please, this is just explanatory. Don't go for all your IT services and put the 6%. We need to do the benchmarking. It's just a real easy example here. Transfer pricing documentation best practice. Obviously, having your transfer pricing report, having your contracts agreements, having the invoices, having the evidence of the service rendered, and being able to demonstrate this to the tax authorities. The key conclusions here, and just to bear this in mind, first stage, able to distinguish between service, employee recharge, and cost recharge. Then, and this is very important, keep evidence of any intragroup service, okay? Then, if we go for an intergroup service, being able to demonstrate that there are no duplication of costs, okay? The intergroup agreement shall not overlap the functions I described in my transfer pricing report. And then, obviously, having a stout benchmarking for the markups I will use. This is my last slide, and that sentence that if you don't when you cannot describe any issue in one sentence, you are not sure of what you are talking about. The same here. If a tax auditor asks you about this service, and if you cannot be able to explain it immediately, so probably it will have some additional questions from the tax auditors. Well, Maria, I believe I can take it to you now.
Sure. Thank you very much. And sorry, everyone, because I have some troubles with my voice this morning. So Joao has just explained us how to value intercompany transactions at arm's length, but mainly between parent company and a subsidiary, or even between two different entities within the same group. However, now I would like to talk about a slightly different situation. Sorry. I didn't find my slide. Sorry again. So now I would like to talk you about a slightly different situation. What happens when there are not two different entities, but we are talking about the same legal entity, for instance, between a parent company and its branch in Spain. In practice, we often find branches that do not close the commercial cycle. What does it mean? That they do not issue any invoices, they do not sign the agreements with the final customer, they only provide internal support to the group. Then the questions here are, if there are no external sales from Spain to the clients, should we still allocate any income to the Spanish branch? And in that case, how we should do it? When we say that the branch does not close the commercial cycle, we mean that the head office is the one dealing with the clients or assuming the commercial rates or even invoicing. But the branch, of course, is still doing important work which creates a value for the group. If an independent service provider performs back office or support services to your group, it will always charge you some amount. So the Spanish branch providing the same internal services should not be different and, of course, get some income. That's why under Article 18 of the Spanish Corporate Income Tax Law, internal support between head office and branch must be always valued at market price. This means we need to consider the branch almost as if it was a separate entity, a different entity, identifying the functions performed, the assets, and the risk assumed, and then concluding with remuneration should be allocated in Spain according to TP methodologies. In most cases, we often use a cost plus for this kind of situations for internal services between parent company and the branch. But always supported, of course, by a proper functional analysis. However, that is not the only possibility for internal services between parent company and branches. In some cases, we have also supported the application of a different method, such as profit split, based on the function, assets, and risks that are located in each of the countries involved. So in conclusion, even if there is not external revenue in Spain, because there are no invoices issued from the Spanish branch, the Spanish branch may still need to declare a taxable income in Spain and always according to TP methodology. Let's now come back to a more typical situation. A subsidiary in Spain is receiving an intercompany charge from another company. For example, a management fee charged by the parent company in France or in Portugal. So what needs to be in place for those expenses to be fully deductible under the Spanish corporate income tax form? First, it must be properly recorded in the accounting, a general principle. So the expense must also be recognized in the correct tax period following the accrual principles in Spain. Second, there must be a clear business purpose. The expense must be linked to the activity of the Spanish company. So here is where the so-called benefit tax becomes so important. Can the subsidiary demonstrate to Spanish tax offices that it really received the service? And of course, that services was really necessary for the activity in Spain. Only the invoice will not be enough to prove during a tax audit in Spain. And finally, the price must be under the arm's length. Even if the service was really received and useful for the Spanish business, if the amount charged was too high compared to market value, the tax authority can still adjust it. And sometimes you cannot prove that the price was really at arm's length with just any kind of proof. But sometimes local or master file becomes compulsory. Spanish law requires a specific transfer pricing documentation in certain cases, and without that documentation, you may face important penalties even if the pricing was correctly calculated and there are no tax adjustments. So when is this kind of local file and master file compulsory here in Spain? Well, when the following two requirements are met at the same time. First, we need to focus on the company group turnover, not only in the turnover of the Spanish entity, but the global company group turnover, including international companies, all the companies worldwide, not only Spanish company, and considering all the entities, even if they are not consolidating for accounting purposes. So when in this situation, the total turnover is over 10 million euros, at the same time, we are meeting the first requirement or the first condition to have compulsory TP documentation. And the second one is when the Spanish entity is having transactions with the same related entity over 250,000 euros during the same year. In such case, when both requirements are met during the same year, the local file is compulsory. But that's not all, because additionally, when the total turnover, calculated as I explained before, is over 45 million euros, in that case, the Spanish entity is also obliged to prepare a master file, not only a local file according to a Spanish regulation. So let's check how those thresholds work in practice in Spain. Here we have in the screen an example. We have a Spanish company named, for instance, A, that belongs to an international group with 50 million euros turnover during 2024 and 2025. During 2024, this Spanish entity A only carries out transactions with one related entity, that is a Belgian company named B, with a total amount during 2024 of 200,000 euros. What happens in this scenario? That the Spanish company is obliged to prepare a master file. Why? Because the total turnover of the group is over 45 million euros. But, however, the Spanish entity does not need to prepare or to present a local file because there were no transactions with the same related entity over 250,000 euros during 2024. However, the situation is slightly different during 2025 because additionally to the same transactions between company B, A and company B, the Spanish entity is also performing some services for a Portuguese company in the same group, company C, and in this case, the transactions during 2025 were over around 500,000 euros. In such a case, additional to the master file already prepared during the previous year, the Spanish entity also needs to prepare a local file for 2025, but only to consider or to demonstrate or to explain the transactions with C, those exceeding 250,000 euros. This is not needed to include the transactions with B because those were not exceeding the Spanish threshold. Of course, there are also some important exemptions which do not need to be included in the compulsory documentation. For instance, transactions with entities under the same tax consolidation group does not need to be reported even when they are over the threshold. And the same when we are talking about transactions for entities within the same joint venture. And of course, remember, even when talking about transactions between normal related entities, those not exceeding a total of 250,000 euros per year does not need to be documented. And still talking about requirements for tax deduction, but as we commented, branches are slightly different because we are not talking about two separate or different entities, but we are just in front of the same legal person. And because of this, Article 18 of the Spanish Corporate Income Tax Law introduced some additional limitations or formal requirements for permanent establishment to be able to deduct intercompany expenses. For instance, some internal payments made by the branch to the head office, such as interest, royalties, or commissions, are not tax deductible in the Spanish corporate income tax. The reason is simple. Remember, you cannot economically pay yourself. We are, from a legal perspective, talking just about one taxpayer, not two different taxpayers. That's why we cannot deduct those kind of expenses when talking about a Spanish branch. However, general and administrative expenses allocated by the head office or parent company to the Spanish branch may be deductible, but only if some additional conditions and requirements are met. As usual, again, like in the normal situation, those expenses must correspond to real and effective expenses. Those need to be necessary for the Spanish activity. But now, only in case of branches, there are additional requirements. Those expenses must be allocated every year using a rational and reasonable criteria that is applied consistently over time. For instance, the allocation of those general management expenses can be done applying criteria such as turnover of each branch or number of employees in every branch or the time spent for every branch. However, this criteria, chosen for 1 year, needs to be applied stable and consistent also in the next year. Because if we are changing the allocating criteria every year without a proper justification, we may create a tax risk. And finally, a specific memorandum explaining those general expenses charged by the parent company together with the allocation criteria applied must be submitted every year together with the corporate income tax form. In practice, we see that many groups focus on transfer pricing documentation, but they forget about this specific and additional obligation that is only applicable to branches or permanent establishment. And this is not exactly the same that local or master file, but we are talking about a different and simple document. And also, to finalize this session, as I promised at the beginning, I just want to make a brief mention or introduction to other tax issues around intercompany charges, starting for VAT. The first question is whether there is a VAT taxable transaction every time that we find a charge between related entities. Of course, no margin does not mean no VAT, because VAT is based on the existence of a supply for consideration, not only on profit. So there may be no profit, and still we may find a taxable transactions for VAT point of view. Only if a real true pass-through situation where one company acts in the name and on behalf of the other entity and recharges exactly the same amount with no added value, we could conclude that the transaction falls outside the scope of VAT. But in practice and in many centralized structures like yours, the entity receiving the original invoice from the third supplier also negotiates, coordinates, and manages the full service, which usually means that this company is acting in its own name and adding some value to the transaction. So in that situation, that will be a taxable transaction for VAT purposes. So if the transaction is a taxable supply, then we should apply the normal VAT rules. For instance, in B2B services, the place of supply is generally the country where the customer is established or located. Or in intra-EU cases, the reverse charge mechanism usually applies. As you know, this means the recipient accounts for the VAT, so there is no financial impact. And what about services between parent company and branch from a VAT perspective? As I already told you several times, branches are slightly different, and it's the same here when talking about VAT. In principle, they are considered a single taxable person, not two different entities. So there should not be a VAT on internal flows between parent company and subsidiary. However, recent case law from the Court of Justice of the European Union, but also from the Spanish courts, have concluded that in this principle, this general principle, is not always applicable, directly applicable, especially when one of the entities is part of a VAT group in its country. In those cases, the head office or parent company and the Spanish branch should be treated as separate taxable person for VAT purposes, so we may need to declare those transactions under the VAT returns. Finally, VAT is not, of course, the only tax to analyze when we are talking about intercompany transactions. Withholding taxes are also very important. For services between parent company and subsidiary, which are very common, the starting point to analyze if withholding tax must be applied is the double taxation treaty. Normally, under Article 7 of the OECD model, the profits are just taxable in the country of residence where the entity rendered the services is located, unless this entity rendering the services has a permanent establishment in the client's country. But in the general and most common situation where the entity of the group is the parent company is rendering services to the Spanish entity, to the Spanish subsidiary, normally this does not have a permanent establishment in Spain. So when the Spanish entity is paying those services to the mother company, Spanish withholding taxes should not apply based on the double taxation treaty. But of course, it's always very important to obtain a valid tax residence certificate for the mother company rendering the services to be able to prove the tax exemption in the course of a Spanish tax audit. And finally, another example of how the withholding taxes may apply in intragroup services, when we are not just talking about normal services, but royalties or payments for the use of intellectual property, licenses, or know-how. In this situation, the application of the withholding tax is quite different because under the treaty rules, those payments are usually taxable in the country where the payer is located, not where the recipient is located, like in the services. And the double taxation treaty may reduce the withholding tax rate depending on the country. But normally, withholding tax are triggered on the payment of royalties or license. If no treaty applies, with a reduction of the percentage of withholding tax applicable, the general one applicable here in Spain for payment of royalties is 19 when the payment is made to a EU company, or 24% when payment is done or made to a different entity outside of the European Union. Lastly, in addition, even when no withholding tax is applicable for services, for example, reporting obligations may still arise in Spain. So when talking about intercompany services, please do not only analyze TP obligations, but also tax implication. an even formal reporting obligation, because here in Spain, we have a specific tax form just to provide information to tax offices about all the payments made to non-resident entities, even when no withholding tax is applicable based on the double taxation treaty or even based on other internal tax reliefs. And that's all for my side. I hope it was not too hard and you get some red lights or general ideas. So every time that you have any service transaction between related entities, you can also have an idea about the tax implications. I don't know if there is any questions already.
It was perfect, Maria. Very good. No, I'm checking the Q&A here. I believe we don't have questions so far, but please feel free.
Please, do it right now if you have any, or you can even send later an email, because yes, I'm gonna share our contact details in the last page. In the last page of the presentation, you can also find our details. So any of us will be very pleased to help you with your issues if any arise after we finish.
Hi, Marianne and Joao. You have some questions in the Q&A.
Okay, so let's check.
Sorry, I was checking it. Okay, sorry. No, because maybe it's me that I'm not able to. Okay, I see them now. Okay, I believe the first one will be more with Maria.
Yeah, I don't know if everybody can read it, so I will do it. Generally speaking, does the revenue from a foreign group entity or parent company for services need to be counted in the turnover that the Spanish entity generates when assessing if the company meets the threshold and requires an external audit? Well, I believe we are mixing a couple of different things. One thing is the thresholds or limits to have compulsory documentation. Okay, here in Spain, it's not necessary, it's not compulsory to submit the local and master file in a specific deadline, different than any other tax return. When both thresholds are met, you need to prepare the documentation, and this may be available at any time that the Spanish tax office is requested, okay? But we do not need to request it. And for those thresholds, I think this is the question, you need to consider, yes, the turnover of all the entities within the group, even the parent company, okay? And we do not eliminate transactions between parent company and subsidiary. We group, or we add all the turnovers within the group, and then we check if the thresholds are exceeded or not. And when they are exceeded, we need to prepare the documentation, and this must be ready in case of a tax audit is started by tax offices. I don't know if this is answering correctly the question. If not, you can ask again.
I believe you have another one, Maria.
Sorry, there is a context. Maybe this is helping. Yes, you mean that the Spanish entity is generating external revenue for the customers, but also gets remuneration for services from the parent company. Yes, when we are talking about the threshold to check if we need to prepare or not prepare transfer pricing documentation, we do not separate those kind of services, external services and internal services. We just take the full turnover for every country. Now I think it's more clear, and hopefully I answered your question. I don't know if there is anything else.
There is another question, but let me just add one thing, Maria, maybe to who put this question, we can send, besides this presentation, that brief slide we have about the thresholds in Spain. So I believe it will help. But yes, we have another question here, and I believe it relates more with taxes than with my economic part.
Do you still need to obtain a certificate of residence even if the double taxation agreement stipulates 0% withholding tax on services or royalty? Yes, that's exactly when the certificate is necessary, because the certificate proves to Spanish tax offices that the other entity is really a resident of France or whatever. So when you prove that the other entity is a tax resident of France, is when you can apply the double taxation treaty between Spain and France. So that's why you need to get the certificate to prove to the Spanish tax office that you did not apply any withholding tax based on the double taxation treaty, because the other party is really a tax resident of France or any other country. Anything else?
I don't think so, but at what? Yes, we have another one here. Yes, about the timings of the submissions of the forms you have mentioned, Maria.
Well, not really sure about the previous slide. Probably you are talking about the last slide where I mentioned that sometimes we need, yeah, thank you. When you are doing payment of intragroup services or royalties, even with no withholding tax applied, we need to report those payments to non-resident entities to the Spanish tax offices. And when? Well, it will depend on the size of the Spanish or turnover of the Spanish entity. For instance, when we are talking about entities, a Spanish entity with a turnover over 6 million euros in the previous year, all the tax returns, even VAT, are submitted on monthly basis. So this specific form I was mentioning for payment to non-resident entities is following the same deadlines. It should be due on monthly basis, okay? Normally from first day to the 20th day of the following month. However, if it is not a big entity with turnover not over 6 million euros, normally all the VAT and withholding tax returns are submitted quarterly. So this specific form, reporting payments to not withholding taxes or to non-resident entities, are also submitted on quarterly basis. There is also an annual report or annual summary with additional information, because the monthly or quarterly tax return is just giving information about numbers, okay? No specific detail about every client or supplier, sorry, or every payment. Those specific details for every payment and every supplier is included in the annual summary. In both cases, with the quarterly and monthly returns, the annual summary is submitted during January the following year. I think there's another one, but this is more for you, Joao. Are the STP principle for intragroup transactions also applicable in case of revenue split between group entities? Do you see this?
Yes, I'm checking if arbitration different countries working on same global engagement. Yes, even there is a method in transfer pricing called the profit split, so totally applies here. Okay, this is a method, and you can use this method. We have some cases, and it's very common to use it here, where you mention various professionals in different countries working for a project. And yes, what do you do in these cases? You must, let's say, one group entity engages with a third party to do a project. You get a professional from Spain, a professional from France, a professional from Mexico. You render the service and you get your profit of 10. Then you will allocate this 10 according to the functions, risks, and assets of of each person or each entity involved. Okay. Then you have some math, some model, economic model to apply here. But yes, you can totally do that, and it is written in the OECD guidelines and in Spanish transfer pricing regime, and in almost every transfer pricing regimes in the world, you can apply profit split. It's a transfer pricing method. I don't know if I was clear on this, or if you have any other questions, please do.
So I believe that's all. No new question arising. Let me check here. One comment. Thank you. You're welcome, Liv. So thank you. Just on time. 5 minutes left. Again, we are at your disposal, Joao and myself. So at any time that you have any question about international taxation or TP, not only intragroup services, but in general TP obligations, you can of course contact us. Thank you very much.
Many thanks.